I mean, you're right. We expected this downgrade to growth. That had been trailed just before the new year, so there's no surprise there. I think the key thing, let's not miss the wood for the trees here. Nobody believes that China's economy is growing at 6.5%, 6% at all now. I think there's a widespread scepticism over the official GDP data. We have our own measure, our activity proxy. That puts growth just below 5%. It's slowing. It's not collapsing, but it's slowing. The question, I think, the key one that you're right, are the measures announced today enough to help stabilise the economy? I think the jury's still out. What's key to me is there's a raft of these measures that's been announced. The deficit target that they're still looking at, 2.8% of GDP, doesn't look like there's much in the way of widespread fiscal stimulus here. And we know that the People's Bank's been slightly hesitant on the monetary front too. So it doesn't look like they're going to flood the economy with stimulus. I wouldn't expect to see a big pickup in growth this year either.
OK, there has been a big concern about debt levels in China from what's been announced in this package of measures. What is it going to do on that front, and what are the broader implications of rising debt in China?
This is the existential problem facing the Chinese at the moment. The central issue is, on the one hand, these rising financial stability risks. Beijing's gone as far in recent months as to frame this as a national security risk. So it's really high up the agenda, but on the other hand, a slowing economy. How do they trade those two things off? At the moment, it feels to me like they're trying to tread this rather careful path in the middle, giving the economy enough juice to keep growth going and stop the economy from slowing further, but on the other hand, not exacerbating the concerns, particularly on the corporate debt level front. OK,
Dan's got a question for you.
Hi there, Neil. Dan here in Abu Dhabi. What did you make of some of the commentary that we heard today from policymakers in China? Premier Li Keqiang warning of a grave and complicated environment in downgrading that growth target for Beijing. But tell me, why are Chinese equity markets putting this to one side? How do we explain the recent outperformance?
I think you can explain most of the recent outperformance of Chinese stocks simply by the fact that some of the tensions on the trade front have dissipated. I mean, as it happened, we never thought at Capital Economics that trade wars were going to be a big challenge for China's economy, but they were quite clearly a headwind for the equity markets. Over the past few months, we've seen progress on this front. It looks like we're edging towards a deal with the US. And I think that's given a bit of support to stocks, particularly when you look at the component parts of the Shanghai Composite, the bits that have, the stocks that have really rallied over the past few days and weeks that really look like they're the ones that are most exposed to trade. So I think you could explain the rally in stocks not through what's happening at a macroeconomic level, but more through signs of progress on trade.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.